You have $50,000 sitting in front of you right now. If you put it into the stock market, you get exactly $50,000 working for you. That's it, dollar for dollar. What you see is what you get. But if you take that same $50,000 and put it into real estate, you now control a $250,000 asset, 5 times the buying power, from the exact same starting amount. And by the end of this video, you're going to understand exactly how that gap turns a boring 3% appreciation rate into 15% cash-on-cash returns. The kind of math that quietly builds generational wealth while you sleep. No crypto, no options trading, no get-rich-quick nonsense. Just a financial mechanic that banks have offered for decades and most people never think to use. Let's break it down, okay? So the concept here is called leverage. And before your eyes glaze over, leverage is not a scary word, it's just a tool. And like any tool, it depends entirely on how you use it. Here's how it works in real estate versus stocks. When you buy stocks, you trade your cash for shares. $1 in buys $1 of stock. If you have $50,000, you buy $50,000 of an S&P 500 index fund. Straightforward, clean, no mystery. Now real estate works completely differently because of one entity, the bank. When you buy a property, the bank says something incredible. They say, put down 20% and we'll loan you the other 80%. So on a $250,000 house, your down payment is $50,000. The bank covers the remaining $200,000. That means with $50,000 in cash, you now own, or more accurately, you control, a $250,000 asset. You didn't earn $200,000 extra dollars. You didn't win the lottery. The bank simply handed you a financial multiplier. And that multiplier is 5 to 1. Now here's where it gets genuinely exciting. Let's say that property appreciates by 3% in 1 year. That is below the historical average for real estate, by the way. Historically, U.S. real estate has appreciated around 4 to 5% annually. So 3% is conservative. 3% of $250,000 is $7,500. Your property went from $250,000 to $257,500. Now, if you had put that same $50,000 into stocks and the market went up 3%, you'd have made $1,500. Same starting money, same 3% growth rate. One gave you $1,500, the other gave you $7,500. That is 5 times the gain, from the exact same appreciation rate. And if you calculate your return on your actual cash invested, your $50,000, that $7,500 gain represents a 15% cash-on-cash return. 15%. From a 3% appreciation rate. This is what real estate investors mean when they talk about leverage being the cheat code of wealth building. The bank's money amplifies your returns. Now I know what some of you are thinking, and we need to address it. But what about the mortgage? Don't I have to pay the bank back? Doesn't the interest eat my gains? Great question. And the answer is, the tenant pays the mortgage. See, when you buy an investment property, you're not the one making the monthly payment. You rent the property out, and the rental income covers the mortgage, the taxes, the insurance. Ideally, there's even cash left over every month that goes into your pocket. So the bank loans you $200,000. Your tenant pays back that loan over time, and you keep the property, an asset that's appreciating, building equity, and generating cash flow. Compare that to buying stocks on margin. Yes, you can leverage stocks too. Brokerages will let you borrow against your portfolio. But there's a critical difference. If your stock portfolio drops by a certain percentage, the brokerage issues a margin call. They force you to sell at a loss. You can get wiped out overnight. Real estate doesn't work that way. If the property value dips temporarily, the bank doesn't call you and demand immediate repayment. As long as you're making the monthly payment, which again the tenant is covering, you hold the asset. You ride out market dips. And historically, real estate always recovers and continues climbing. This is why real estate has created more millionaires than any other asset class in history. It's not magic, it's mechanics. The 5 to 1 leverage gap means your money works 5 times harder. Your returns are amplified, and the debt, which scares most people, is actually being serviced by someone else. Now let's be clear about something before we go further. This is not permission to go buy a property blindly tomorrow. Leverage is powerful, but it cuts both ways. If you buy a bad deal, wrong location, bad tenant, overpriced purchase, leverage amplifies that mistake too. The deal has to cash flow. The numbers have to work. You need to understand your market, your expenses, and your exit strategy. But when you get it right, the math is almost absurd. Let me paint the full picture for you. You put $50,000 down on a $250,000 rental property. Your tenant pays down the mortgage every month for 30 years. Meanwhile, the property appreciates at a conservative 3 to 4% annually. After 30 years, that property, based on 3% annual appreciation alone, would be worth roughly $607,000. The mortgage is fully paid off by your tenant, so you now own a $600,000 asset free and clear. You turned $50,000 into over $600,000, and you didn't add a single dollar of your own money beyond the initial down payment. Try doing that with $50,000 in an index fund. And look, I'm not anti-stocks. Stocks are fantastic. They're liquid, they're passive, they require zero management. You should absolutely be investing in the market. But if you want to understand why real estate investors build wealth so much faster, especially in the first decade or two, it comes down to one thing: leverage, the bank's financing edge, 5-to-1 buying power, 3% appreciation becoming 15% returns, someone else paying down your debt, and an asset that historically never goes to zero. That's the gap. That's the difference between saving your way to wealth and leveraging your way there. Now, I want to leave you with one shift in thinking before we wrap up. Most people look at a house and see a place to live. Real estate investors look at a house and see a lever, a tool that takes their modest savings and multiplies their position in the market. The bank is willing to give you that lever. They've been offering it for decades. The question is whether you're going to use it. That's the 5-to-1 leverage gap. And now you know how it works. If this was helpful, there's more on the channel.